Welcome back to the Magic Market, where we bring a little enchantment into financial insights. Today, we're diving into Disney's latest earnings report, analyzing everything from streaming performance to the return of theme park revenues. This report has a lot to tell us about where Disney is headed, so let's get into it. First, let's break down what an earnings report is and why it matters, especially for a massive company like Disney. Think of it like a quarterly report card. It reveals Disney's financial performance over the past 3 months, including successes, challenges, and future investments. Disney's earnings reports are closely watched, not only by investors, but also by analysts, competitors, and even fans, as they can influence everything from streaming trends to travel. The latest report gives us insights into Disney's core metrics: total revenue, operating income, and net income, each telling us something critical about the company's health. So, why do these numbers matter? For a company as diversified as Disney, each segment, media networks, direct-to-consumer, which includes Disney Plus and Hulu, parks and experiences, and studio entertainment, has its own strengths and weaknesses. Disney's business is like a four-legged stool. If one segment struggles, it impacts the entire balance. In this breakdown, we'll analyze how each division performed, comparing it to last quarter and the same quarter last year. Our goal is to see what Disney's report card says about its future direction. Alright, let's start with the core metrics that paint a picture of Disney's current financial health. These are the numbers that analysts, investors, and even Disney's competitors focus on each quarter. Let's start with Disney's total revenue. Revenue reflects all the money Disney brings in across its divisions, from streaming services to park admissions and merchandise sales. This quarter, Disney reported total revenue of $22.33 billion, up 9% from the same quarter last year. That year-over-year growth is a promising sign, showing strong demand across Disney's portfolio. Increased revenue could indicate factors like higher attendance at parks, popular new content, or a rise in Disney Plus subscribers. However, if revenue had been down, it might have signaled challenges like lower spending in parks or increased competition in streaming. Next, let's look at operating income. This metric shows us how effectively Disney manages its core businesses before paying interest and taxes. Disney's operating income for the quarter was $3.84 billion, up from last year. This increase suggests that Disney has been controlling costs in its core segments. A strong operating income often reflects efficiencies across Disney's divisions, such as cost savings in content production or streamlined park operations. But if this number had been lower, it might have pointed to rising costs, such as marketing expenses for Disney Plus or maintenance at the parks. This number gives insight into how each Disney segment is performing on its own. And finally, let's examine net profit, also known as the bottom line. This is Disney's true profitability after all expenses and taxes. For this quarter, Disney reported a net profit of $1.28 billion, which indicates Disney is profitable after covering its costs. A positive net profit tells investors that Disney is generating value even after investments and operational costs. However, if Disney reported a net loss, it could have signaled financial strain or investments that have yet to pay off. Net profit is particularly crucial for long-term investors, as it often correlates with shareholder returns. Now, let's dive into each business segment to see what's driving these numbers. First up, let's dive into Disney's media networks, a segment that includes some of the most iconic channels on television, like ESPN, ABC, and Disney Channel. For decades, these networks have been pillars of Disney's revenue, contributing billions each year. But with the rapid shift to streaming and changing viewer habits, Disney's traditional TV model is under significant pressure. Disney's Media Network segment reported revenue of $6.68 billion this quarter, a slight decrease from the previous year. This decline reflects an ongoing trend. Cable TV subscribers continue to cut the cord, moving away from traditional pay TV packages in favor of digital streaming services. But let's dig deeper into what's driving these changes and the specific challenges Disney faces in this segment. One major issue is the decline in cable subscriptions. Disney's cable networks, particularly ESPN, have historically commanded high subscription fees from cable providers. However, as more households cancel cable subscriptions, this revenue stream shrinks, Industry-wide, US cable and satellite TV subscriptions have dropped by about 7% annually, and this trend shows no signs of slowing down. For ESPN alone, fewer subscribers mean less licensing revenue, even as costs to secure broadcasting rights for live sports continue to climb. ESPN's value proposition has always been its exclusive sports content, but sports broadcasting rights are incredibly costly. Disney has to pay billions each year for contracts with the NFL, NBA, and other leagues, and these costs continue to rise as competition for sports streaming intensifies. With fewer cable subscribers to offset these costs, ESPN is under pressure to innovate and find alternative revenue streams. Next, there's ad revenue, another critical component of media networks' earnings. Advertising on traditional TV has been a reliable income source, especially during live events, but advertising dollars are shifting to digital platforms. Advertisers are now favoring targeted, data-driven campaigns that online platforms like Google and Facebook offer. For Disney, this shift means fewer ad dollars for channels like ABC and Disney Channel, as brands move their budgets to digital. One of the challenges for Disney's networks is adapting to this new ad landscape. They're experimenting with addressable advertising, which uses data to serve more targeted ads to viewers on digital and linear TV. This approach could help Disney regain some ground by making ads more relevant and valuable to advertisers, but it's still in its early stages and hasn't yet offset the revenue loss from traditional TV ads. Disney's strategy to combat these headwinds in media networks involves a pivot to digital, especially with ESPN+. ESPN+ is Disney's answer to the rising demand for streaming sports content. Launched in 2018, ESPN+ has grown steadily, reaching 24.3 million subscribers this quarter. However, ESPN+ is a different model than traditional ESPN. It doesn't include all of ESPN's most watched games and events. Instead, it offers exclusive content like UFC, niche sports, and select broadcasts, as well as access to ESPN's library of on-demand shows. ESPN Plus presents both opportunities and challenges. On one hand, it gives Disney a foot in the sports streaming market, which is projected to grow significantly. On the other, ESPN Plus alone cannot fully replace the revenue lost from cable. Disney is reportedly exploring a more comprehensive streaming option, potentially a direct-to-consumer version of the full ESPN channel, which could allow it to bring all major sports content under a single streaming platform. However, executing this shift is complex, as it would require renegotiating contracts with cable providers and sports leagues, a process that's costly and politically sensitive. ABC, another key player in the media network segment, is also experiencing shifts due to changing viewer preferences. As traditional network television viewership declines, ABC faces pressure to keep audiences engaged and compete with streaming. Shows like Grey's Anatomy and The Bachelor remain popular, but their ratings are not immune to the industry-wide decline in linear TV viewership. ABC has responded by developing partnerships with Disney+, offering next-day streaming of select shows. This approach aims to retain viewers who still enjoy ABC's content but prefer watching on demand. Furthermore, ABC News, a division within ABC, has adapted by expanding digital content through ABC News Live, a 24/7 streaming channel that provides live news to audiences on platforms like Hulu and Roku. ABC's transition to digital aligns with broader trends in news consumption, as more viewers turn to online news sources. However, monetizing news streaming remains challenging, as it typically generates lower ad revenue than primetime television. Disney's goal will be to integrate ABC's strong content with Disney Plus and Hulu in a way that maximizes its audience and monetizes more effectively. Disney Channel, once a staple for young audiences, faces its own unique challenges in the current landscape. Younger viewers are shifting from traditional TV to platforms like YouTube, TikTok, and Disney Plus, making it harder for Disney Channel to retain its audience. Shows like The Suite Life of Zack and Cody and Hannah Montana once drew huge audiences. But today's kids are more likely to watch content on demand or engage with short-form videos online. To adapt, Disney has been shifting some of Disney Channel's popular content to Disney Plus, where it can reach a broader audience. Shows like High School Musical, The Series, and The Proud Family, Louder and Prouder are examples of Disney Channel programming that have found new life on streaming. By moving kid-focused content to Disney Plus, Disney aims to capture younger viewers who prefer streaming, while gradually reducing costs associated with traditional cable broadcasting. In summary, Disney's media network segment faces headwinds. but Disney is laying the groundwork to capture new revenue through streaming and digital advertising. Adapting to these industry shifts is crucial, as each move will shape how Disney stays relevant and profitable in an increasingly digital media landscape. Now let's turn to Disney's direct-to-consumer segment, which includes its streaming platforms Disney+, Hulu, and ESPN+. This has become one of the most critical parts of Disney's business, especially as streaming continues to dominate the entertainment industry. In fact, Disney's streaming strategy is largely viewed as the backbone of its future growth. With competition from other major players like Netflix, Amazon Prime, and HBO Max, the stakes are high, and investors are watching closely to see if Disney can turn its streaming services into consistent profit engines. This quarter, Disney reported direct-to-consumer revenue of $5.9 billion, a notable increase from the same quarter last year. However, profitability remains a challenge as Disney continues to invest heavily in content and technology to expand its streaming offerings. Let's break down the performance of each streaming platform and look at some of the opportunities and challenges Disney faces in this crucial segment. First up, Disney+. Launched in late 2019, Disney+ has been a massive hit, attracting millions of subscribers around the world thanks to beloved franchises like Star Wars, Marvel, and Pixar. As of this quarter, Disney+ has 146.1 million subscribers. While that's a strong number, it's down slightly from previous quarters, largely due to a price increase that led some subscribers to cancel. Disney is aiming to make Disney+ profitable by 2024, but it's a challenging target. The platform is currently investing billions in new content, both in established franchises and original series like The Mandalorian and Loki, which have been instrumental in attracting viewers. However, Disney+ is still in a growth phase, with significant spending on content and technology that has yet to pay off fully in terms of profitability. One recent development is Disney's plan to introduce a Disney+ ad-supported tier, allowing more budget-conscious viewers to access the service at a lower price point. This move is designed to increase subscriber numbers while also bringing in ad revenue, a model that's been successful for Hulu. Additionally, Disney+ is expanding internationally, with launches in new regions and local content tailored to audiences in places like India and Latin America, helping to drive growth outside the US. Next, we have Hulu. Hulu has been in the streaming game longer than Disney+, and it remains one of the top streaming platforms in the U.S. Known for a diverse mix of on-demand shows, live TV, and original content, Hulu now has 48.3 million subscribers, a number that's been relatively stable as Hulu has established itself as a go-to service for network TV fans who prefer on-demand streaming. Hulu's strength lies in its library of current TV shows, exclusive content, and original series like The Handmaid's Tale. However, Hulu's future ownership is a hot topic. Disney currently holds a majority stake in Hulu, but is expected to acquire the remaining shares from Comcast in 2024. Owning Hulu outright would give Disney full control over its content and strategy, allowing for deeper integration with Disney+ and ESPN+. However, this acquisition comes with a high price tag, which could impact Disney's balance sheet. One key growth strategy for Hulu is its ad-supported model. About 70% of Hulu's subscribers are on ad-supported plans, which generate significant ad revenue and help offset content costs. This model has been successful, and Disney plans to leverage this experience to optimize ad-supported options on Disney+ and ESPN+ as well. Finally, let's look at ESPN+, Disney's sports streaming service. ESPN+ has been steadily gaining subscribers and now serves 24.3 million. ESPN+ offers exclusive sports content, including UFC, college sports, and niche leagues, providing an alternative for sports fans who want streaming options. While ESPN+ doesn't offer all of the major games broadcasted on ESPN, it does serve as a valuable entry point for Disney's direct-to-consumer sports offerings. Additionally, ESPN+ has the potential to expand internationally, especially in markets where American sports are popular. As streaming sports grows in popularity, Disney is considering expanding ESPN's reach by creating a more comprehensive streaming option that might eventually include live, high-demand games currently exclusive to ESPN's traditional cable channels. In summary, Disney's direct-to-consumer segment is rapidly growing, but Disney still faces significant challenges in making these services profitable. Each platform, Disney+, Hulu, and ESPN+, plays a unique role in Disney's streaming ecosystem, and the company's ability to balance growth, content costs, and subscriber acquisition will be key to its success. Now let's move on to one of Disney's most iconic segments, parks, experiences, and products. This segment includes Disney's theme parks, resorts, cruise lines, and merchandise. It's where the magic of Disney comes to life for millions of fans around the world. This quarter, Disney's Parks, Experiences, and Products segment brought in $7.8 billion in revenue, reflecting strong demand for in-person experiences as the world continues to recover from the pandemic. Disney parks, particularly in the US, have seen a strong rebound, with high attendance rates and increased guest spending on food, merchandise, and Genie Plus passes. However, international parks, like those in Hong Kong and Shanghai, have faced headwinds due to local restrictions and slower recoveries. Despite these challenges, Disney is investing in new attractions and park expansions, like the recently announced Frozen and Zootopia-themed areas, to draw in more guests and keep experiences fresh. On the cruise line side, Disney has been ramping up operations with demand rising as more families seek vacations. Disney is also adding new ships to its fleet to accommodate growing interest in cruises. And beyond parks, Disney's merchandise sales have been strong, with consumers eager to buy products tied to popular franchises like Marvel and Star Wars. Looking ahead, Disney plans to continue enhancing the guest experience through technology, like the Genie Plus app, which helps guests manage their time and attractions more efficiently. These enhancements, combined with new attractions and events, should keep parks and resorts as a core revenue driver for Disney. Last but not least, let's dive into studio entertainment. This segment includes Disney's film and TV studios, which produce content for theaters, Disney Plus, and third-party distribution. With franchises like Marvel, Star Wars, and Pixar under its belt, Disney's studios are critical for building intellectual property that powers the entire company. This quarter, Disney's studio entertainment revenue reached $2.1 billion, bolstered by box office successes like The Little Mermaid live-action remake and Guardians of the Galaxy Vol. 3. However, theatrical revenues have faced challenges as consumer viewing habits shift, and more people opt to wait for streaming releases rather than heading to theaters. Additionally, the rising costs of producing blockbuster films are putting pressure on margins. To adapt, Disney has been increasingly using its film and TV content to support Disney Plus and Hulu, creating a virtuous cycle where successful theatrical releases generate buzz and later drive streaming subscriptions. Disney is also exploring a balanced release strategy. Some titles go straight to streaming, while others get theatrical releases first. This dual approach allows Disney to maximize revenue and tailor each release to audience demand. So what does Disney's earnings report tell us about the company's future? Disney is in a period of transformation, adapting to a world where streaming, digital experiences, and shifting consumer preferences are redefining entertainment. For Disney's media networks and direct-to-consumer segments, the key challenges will be finding ways to make streaming profitable while managing the decline in traditional TV revenue. Parks and experiences remain a strong revenue source, with promising growth in guest spending and expansion plans. Studio entertainment continues to be a powerhouse, but adapting to changing theatrical and streaming demands will be crucial for future success. Overall, Disney is facing both exciting opportunities and real challenges. How Disney navigates this landscape will not only shape its own future but also set trends across the entire entertainment industry. We'll be keeping a close eye on Disney's progress, and as always, we'll bring you the latest insights right here on the Magic Market. Thanks for joining us for this breakdown of Disney's latest earnings report. Be sure to like and subscribe if you found this helpful, and let us know in the comments what you think about Disney's strategy. Until next time, keep the magic alive and stay tuned for more financial insights on the Magic Market.